The market is not functioning properly. There has been a widespread loss of confidence, and major sectors of America's financial system are at risk of shutting down.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
Now it's official, we are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago.
What we're facing right now is really serious. I mean, we are on the brink of a 2008-style financial crisis.
Hey, what's up, guys? John here. Do you have a goal of investing during this upcoming recession? Maybe investing in distressed real estate, or growing or starting a business, buying a work truck. Do you have a goal of advancement? When the rest of the world's pulling back, you get aggressive and grow your net worth. Well, if so, I'm going to share with you what banks are doing, what wealthy individuals are doing, and wealthy institutional investors, what they are getting ready to do, clearly with facts. Take a look at this. First, from the CEO of Bank of America. CEO of Bank of America said that the average FICO scores 770 on their new credit cards, right? 770 FICO score. Consumer creditworthiness remains strong according to Bank of America, which shows the average FICO score on consumer credit cards 770, average FICO score on auto loans 789, the average FICO score on new mortgages 768, average FICO score on home equity lines of credit 792. You know, in 2020 and 2021, you could have a 680, 700 credit score, 720 credit score, and you'd be completely fine. You go get, a great loan. You'd have no problems. But now as banks start to contract and the average credit score in America is a 698, the people that get cut first, people with bad credit and average credit, if you have a credit score below 750, you're going to want to pay close attention to what's happening. So right now, banks are already tightening lending. Banks expect their lending standards across all loan categories to tighten further the second half of 2023. It says right here, U.S. banks report tighter credit, weaker loan demand. Banks report toughest loan standards in years. Banks warn of lending pullback, fueling recession fears. This is what's going to happen. It's very similar to what happened in 2008, 2009. Lenders raised their standards. And the reason for it is because they're sitting on a lot of losses. I believe they're sitting on way more exposure today than they've ever sat on before. For example, U.S. banks are sitting on a record $1.7 trillion in unrealized losses. $1.7 trillion. Now, here's just some context to this. Car prices today. Car prices. If you were to finance a new car, $716 a month is the average payment. To finance a used car, $526. You could buy a used car in 2008, average price $7,986, right? So essentially, 1 year, 14 months worth of car payments on a used car today would buy you the car in cash in 2008. So you could buy on a 60-month loan term, you could buy 4 cars outright for buying 1 car today on payments, right? This affordability crisis is going to continue to get worse and worse and worse. Another realization of that is looking at credit card debt. $850 billion is what they were at in Great Financial Crisis 2008. Now we're over $1 trillion in credit card debt. Average interest rate today, 24.37%. So on a $10,000 balance, 22 grand in just interest, 22,000 in just interest. Average interest rates back then, 2008, 12%. So you go from paying $22,000 in interest over 155 months to $3,147 in interest in 2008 at 12% interest rate. So this affordability crisis is going to continue to get much, much worse. And many people thought that home prices really crashed in the Great Financial Crisis. Home prices, $225,000, $217,000, right? That was, they fell, sure. Many markets, they fell 30, 40, 50%. But today, the average home price, $410,000, right? We have a lot further to go down than we did back then. And we start to look at what investors are doing. They know this. Right here, how Wall Street bought single-family homes. Institutional investors may control 40% of single-family rental homes in the next 6 years. 40%, right? This is going to continue to grow. Blackstone just raised a $30 billion real estate fund. $30 billion real estate fund. Where are they going to invest? Rental housing. Starwood Capital, they're getting ready to raise the distressed real estate fund. They're getting ready to pounce on America. They're getting ready to buy up America. If you have ambitious goals, you want to, invest in real estate, you want to protect and provide for your family by making smart, well-informed, forward-thinking decisions. If your credit is not where it should be, you're not going to likely get financing. You want to have great credit. You want to position yourself for great credit. Go to greatcreditfast.com. Schedule a free strategy session. A free strategy session will tell you exactly what it'll look like to fix your credit score. If you have just one late payment, that one late payment could drop your score upwards of 180 points and stay on your credit report for 7 years. 7 years. So you can go from having great credit, have 1 or 2 slip-ups, and before you know it, you have bad credit, you can't get financing. You're spending all this money on unnecessary credit card interest rates. I mean, you're putting yourself in a really weak position just by having 1 or 2 issues on your report, preventing you from achieving your full potential. Go to greatcreditfast.com, book a free strategy session. We can see how we can help you.